Welcome to this presentation from BJF Trading Group. In this video, we're going to show you something that most traders never get to see. We're going to look at two of our algorithms from the broker's perspective. Specifically, we applied an AI-assisted risk analysis framework to a live account running our phantom drift strategy, and we're going to walk you through exactly what the broker's automated risk system sees when it reviews that account. The key question we set out to answer was simple. Does the masking architecture actually work? Does the broker classify this account as low risk, or does it get flagged? The short answer, the account received a toxicity score of 18 out of 100, classified as low risk, retained on B book, with no hedging required. Let's show you how we got there. Let's start with the problem every arbitrage trader faces. Modern retail brokers have invested heavily in AI-powered risk systems. These systems run in real time, and their job is to identify accounts that are consistently profitable through algorithmic means, especially arbitrage. When they find one, the broker has several options. They can reroute your trades to a liquidity provider, they can widen your spreads, or they can simply terminate the account. The system scanned for very specific patterns. Trade duration, and if you're opening and closing positions in fractions of a second, that's a red flag. Lot sequences. If your position sizes follow a mechanical progression, that gets noticed. Order burst density, multiple orders placed in the same second. Cross-account correlation, similar patterns across multiple accounts at the same broker. And here's the uncomfortable truth. It doesn't matter how good your underlying strategy is. The moment you get flagged, the game is over. You get moved to A book, your fills deteriorate, and your edge disappears. So the challenge isn't just building a profitable strategy. The challenge is building one that stays profitable because it never gets detected in the first place. That is exactly what phantom drift and hybrid masking were designed to solve. Our solution works on two distinct layers. Think of it as a structural layer and a behavioral layer working together. Layer 1 is phantom drift. This is the structural layer. At its core, it's a bounded Martingale system, meaning it builds up positions in a grid pattern that any broker's risk system will immediately recognize as retail Martingale behavior. That recognition is intentional. We want the broker to see a Martingale trader. But underneath that familiar surface, phantom drift is running lock arbitrage across two separate broker accounts, extracting a directional profit that neither broker can see individually. Layer 2 is the hybrid masking strategy. This is the behavioral layer. It adds technical credibility to every single order, using EMA crossovers on higher timeframes to set the trend direction, and Fibonacci retracement levels on lower timeframes to select entry points. Every order looks like it was placed by a skilled technical trader, not a machine. On top of that, the hybrid masking module randomizes stop-loss placement, take-profit levels, trailing stop distances, lot sizes, and even the timing of order closures. The result is that no two orders carry the same metadata signature, which defeats the pattern clustering algorithms that broker risk systems rely on. Neither layer alone is sufficient. Together, they address both dimensions of detection, the statistical patterns and the behavioral fingerprint. Let me walk you through the full operating cycle step by step. Step 1. The system waits for an RSI signal on the 15-minute time frame, confirmed by a reversal candlestick pattern. This is the entry trigger. It's technically based, not arbitrary. Step 2. The first position opens at the minimum lot size in the direction of the signal. Step 3. If the trade moves against us by a defined number of pips, the system adds a second position at a larger lot size. This is the Martingale build-up phase. Each subsequent loss adds another leg at an increased size, following the configured lot exponent. Step 4. This continues until the maximum number of buy-ins is reached, typically 3 to 5. At this point, instead of adding another Martingale leg on the same account, the system does something different. Step 5. It opens a mirror position on account B. This creates a lock. Both accounts are now hedged against each other, and neither one shows a net directional exposure to its broker. Steps 6 and 7. The system runs lock arbitrage between the two accounts. systematically closing components of the lock at profit by exploiting the price feed differential between the two brokers. This continues until the combined profit across both accounts reaches the configured target. Then the lock is closed, the cycle resets, and the Martingale restarts on account B, with account A now acting as the hedge side for the next cycle. The key insight at the bottom of this slide says it all. Each broker sees a net zero account. Broker A sees a balanced position. Broker B sees a balanced position. The combined directional exposure exists only across both accounts simultaneously, and no single broker's risk system has visibility into that. This slide makes the structure concrete. Let's look at exactly what each broker sees. On account A at broker A, the positions are buy 2.3 lots. That's the real directional bet, plus sell 0.1 lots, sell 0.2 lots, sell 0.6 lots, and sell 1.4 lots. Those four sell positions are the hedge legs. When you add it all up, 2.3 minus 2.3 equals 0. Broker A's net exposure reading, 0. On account B at broker B, it's the exact mirror. Sell 2.3 lots is the opposite directional bet, and the hedge legs are buy 0.1, 0.2, 0.6, and 1.4 lots. Again, net 0. Broker B's net exposure reading, 0. From the broker's perspective, both accounts look perfectly flat. Neither one has open directional risk that needs hedging. Both look like clients who are sensibly managing their positions with counter trades. In reality, the BY 2.3 on account A and the SOL 2.3 on account B are the opposite legs of a single coordinated directional bet. When price moves, one side wins, and that's the leg we hold. The losing side gets closed quickly. The broker holding the losing leg sees a normal martingale recovery attempt. The broker holding the winning leg sees a client taking profit on a well-timed trade. Neither broker ever sees the full picture. That is the structural foundation of phantom drift. Now, let's talk about the second layer, the behavioral camouflage. Even if the position structure looks flat to a broker, modern risk systems don't just look at positions. They look at behavior. They ask, does this trading pattern look like a human, or does it look like a machine? And machines have tells. Fixed stop-loss distances, identical lot sizes, orders that close at exactly regular intervals, entries that don't align with any recognizable technical logic. Hybrid masking eliminates all of those tells. Trend-aligned entries. Every order is placed in the direction of the trend as identified by EMA crossovers on the 30-minute or hourly time frame. Orders fire only in the trend direction. If a risk analyst reviews the trade log, every entry has a legitimate technical rationale. Fibonacci pullback logic. On the lower time frame, the system identifies the start of a pullback and targets the 60 to 70% Fibonacci retracement zone with pending limit orders. This is exactly how a professional discretionary trader would structure entries. Multi-layer randomization. Stop-loss and take-profit distances receive random offsets for every single order. No two orders have the same SL or TP. Lot sizes are drawn randomly from a configured range, say 0.10 to 0.25 lots, at a defined step size. And the close timing adds a random window of 7 to 15 minutes on top of the base order lifetime. The combined effect is an order flow that passes the behavioral fingerprinting tests. It looks like a systematic trader who uses technicals but exercises judgment. No two orders are identical. No pattern is regular enough to trigger a cadence detection flag. Now, I want to explain how we actually validated all of this. Because the claim isn't just theoretical. We ran a full empirical analysis on a live account. We developed an AI analytical assistant trained on broker risk management frameworks and applied it to the complete trade history of the Phantom Drift account. 55,777 closed trades across XAU USD, EUR USD, USD JPY, and GBP USD covering 9 months from June 2025 to March 2026. The analysis followed 5 phases. Phase 1. Data ingestion and base metric computation. Duration distribution, lot sequences, win rates, profit factor. Phase 2, toxicity signal scoring across 8 categories, each assessed independently. Phase 3, equity curve modeling, cumulative P and L, maximum drawdown, and recovery profile. Phase 4, dual account hypothesis testing. We ran a cross-correlation analysis looking for simultaneous buy and sell pairs within 5-second windows. We found 329 such windows. In 318 of those, that's 96.7%, the net exposure was exactly 0. This statistically confirmed the two-account lock structure beyond reasonable doubt. Phase 5, broker classification simulation. The AI generated the risk report that a broker's automated system would produce, including the final toxicity score and routing recommendation. What you're about to see on the next few slides is that output. This is the broker's dashboard view of the Phantom Drift account. Let's go through the numbers that matter. 55,777 closed trades in 9 months. That's approximately 440 trades per day. High volume, but not unusual for an automated grid system. Well within the range of a standard retail algorithmic client. Average trade duration, 20 minutes. This is the single most important number on this slide. 20 minutes places this account firmly in the medium-frequency retail category. It does not look like high-frequency trading. It does not trigger the sub-second duration alerts that latency arbitrage detection systems look for. The reason the mean is 20 minutes, despite many trades closing instantly, is that the Martingale legs and lock arbitrage recovery positions are held for minutes to hours. And those longer holds pull the average up to exactly the range brokers associate with grid traders. Win rate 59.8%, profit factor 1.25. Moderate performance. Consistent with a Martingale strategy that's working in a favorable trending market, but not so strong that it triggers a suspicion of systematic edge extraction. 0 trades with stop loss or take profit. This is flagged as medium risk by the broker's system, but it's also completely typical of retail Martingale traders. It reinforces the narrative that this is a grid trader who manages exits manually. The trade duration bar at the bottom of the slide tells the whole story. 68.2% of trades close instantly. Those are the lock exits. 26.7% close within 5 minutes, and the remaining 5% are the longer Martingale and recovery holds. Together, they blend into a mean duration that reads as retail, not as arbitrage. This table is where the strategy's design becomes most visible, if you know what you're looking at. But from the broker's perspective, it tells a very different story. Look at the first 4 rows. The 0.1 lot tier executed 23,172 trades and lost an average of negative $1.74 per trade, for a total loss of $40,262. The 0.2 lot tier lost $46,547. The 0.3 to 0.6 range lost $59,271. The 0.7 to 1.5 range lost $54,597. 4 tiers, all negative. Combined losses of over $200,000. Now look at the last row. The 2.3 lot tier executed 8,681 trades, fewer than any of the small lot tiers, and generated an average of positive $86.55 per trade for a total profit of $751,304. The broker's automated system sees this and thinks, small positions consistently lose money. Large positions occasionally generate big recoveries. That is textbook Martingale behavior. The client keeps doubling down after losses and eventually catches a recovery move. Classic retail grid trader. High probability of eventual account blowup. What the broker cannot see is that the 2.3 lot tier isn't a lucky recovery. It's the arbitrage leg. It's systematically profitable because it's the side of the lock that was held open on the winning account while the losing account closed its position quickly. The broker is looking at half the picture and drawing exactly the wrong conclusion. That misclassification is not an accident. It is the strategic objective of the design. This is the output that matters most. The simulated broker toxicity scorecard. The AI assistant evaluated the account across 8 signal categories, assigning a rating to each one based on the same logic a broker's automated risk system would use. Trade duration. Low. The 20-minute average keeps this account out of the HFT detection zone. Latency and HFT indicators. Low. No sub-second order patterns that would trigger enhanced monitoring. News and event trading. Low. Trade timing is distributed across all hours with no clustering around economic releases. Martingale lot scaling, medium. The progressive lot structure is visible and gets flagged as medium risk, but this is intentional. Medium risk means the broker expects eventual loss. That's exactly the profile we want. No stop loss, medium. Flagged but consistent with retail martingale behavior. Spread and LP toxicity, low. The average lot size and trade pattern generates acceptable spread flow from the broker's perspective. Cross-account arbitrage signal, not detected. This is the most important line on the scorecard. The two-account lock structure is completely invisible to the broker's single-account risk system. The overall toxicity score, 18 out of 100. Classification, low risk. A low toxicity score is necessary, but it's not the only reason a broker keeps an account. Revenue matters too, and this account generates substantial revenue for the broker. Over 9 months, the strategy traded 34,224 total lots. At a standard XAU-USD spread, we estimate the broker collected approximately $102,000 in spread revenue from this single account. At the March 20-26 pace, nearly 10,000 lots traded in 1 month. That projects to $30,000 to $45,000 per month in spread income going forward. The high-frequency re-entries that the Martingale structure creates actually work in the broker's favor here. Every time a new grid leg opens, that's another spread payment. The broker collects on every single one of those 440 daily trades. The simulated broker recommendation generated by our AI assistant was: retain on B-book standard monitoring tier, high account blow-up probability is favorable, no LP hedging required. In other words, the broker sees a high-volume client who is generating strong spread revenue, appears to be running a losing strategy that will eventually blow up, and shows no signs of toxic arbitrage flow. From the broker's commercial perspective, this is an ideal B-book client. One of the most important outputs of this research is what we call the dual report framework. And this is something genuinely new in strategy validation. When we ran the AI analysis, we intentionally generated 2 separate reports simultaneously. A true analysis report that decoded exactly what the strategy is doing, and a simulated broker view report that reflects only the signals accessible to a single broker risk system. The true analysis report confirmed everything we designed the strategy to do. Two-account lock arbitrage structure confirmed at 96.7% precision. Net exposure on each broker independently equals 0. The small lots are deliberate hedge camouflage. The 2.3 lot tier is the arbitrage recovery leg. The December 2025 open sell positions on account A are the losing leg of a trade where account B is currently holding a winning BY position worth approximately $63,000. And the strategy is detection resistant by design. The broker view report shows what the risk desk actually sees. Average duration of 20 minutes, retail, not HFT. Martingale grid, expected to self-destruct. No stop losses, my typical retail mistake. Open losing positions, Martingale bag hold. Profit factor 1.25. Unstable and trend dependent. And a final toxicity score of 18 out of 100, with the recommendation to retain on B-book. The fact that both reports can be generated from the same data, and that the broker's report reaches exactly the wrong conclusion, is the proof of concept. The masking architecture works. This closed-loop validation approach is something we now apply to all strategy development at BJF Trading Group. It allows us to confirm that the underlying mechanism is functioning before deployment and simultaneously confirm that the broker's system cannot detect it. Let me summarize the 4 key findings from this research. Finding 1. Detection resistance confirmed. The two-account lock arbitrage structure is invisible to single broker risk systems. 318 of 329 simultaneous buy/sell windows showed net exposure exactly 0. A statistical confirmation, not a theoretical claim. Finding 2. Martingale as camouflage. The 5-tier lot structure, from 0.1 to 2.3 lots, reads as retail martingale to any risk system. The small lots intentionally lose $200,000 to fund the cover story for the 2.3 lot arbitrage leg, which generates $751,000 in profit. Finding 3. Hybrid masking eliminates behavioral flags. Randomized SL, TP, lot size, and close timing defeat pattern clustering and cadence detection. The order flow appears technically motivated and human-generated. Finding 4. Broker revenue alignment. The strategy generates $30,000 to $45,000 per month in estimated broker spread income. The broker is financially incentivized to keep this account, and the martingale narrative sets the expectation that it will eventually blow up. Both of those things work in our favor. The lesson from all of this is straightforward. In today's environment, a profitable strategy isn't enough. You need a strategy that stays profitable because it operates below the detection threshold indefinitely. Phantom drift and hybrid masking are the result of years of research into how broker risk systems actually work and what masking architectures hold up against them at scale. The analysis we showed you today wasn't theoretical. It was based on 55,777 real trades on a live account, analyzed using the same logic a real broker risk desk would apply. Both strategies are available now through the BJF Trading Group platform. If you'd like to learn more, about the documentation, the setup process, the AI-assisted broker analysis toolkit, or the broader masking suite including Lock CL3, Bright Trio, and Bright Duo, visit us at bjftradinggroup.com or reach out directly at cs@itics.ca or support at bjftradinggroup.com. Thank you for watching. Please subscribe to our YouTube channel.